Welcome back. You're watching Markets at Noon, and let's go across to John Verghese, the Chief Financial Officer of Popular Vehicles. Now, sir, in the fourth quarter, if you look at the company's new vehicles and pre-owned cars have seen a degrowth in terms of volume on a YY basis. But going forward, say for the first half of FY25, what is the kind of volume outlook that we can see from the company, especially when it comes to electric vehicles and premium vehicles, where the company has been very bullish on?
Good afternoon. Thanks for having me here. Yes, you're right. Q4, there was a dip in the volumes, primarily because of the luxury brand that we have. Uh, the volumes that were expected to be received from the OEM, we were not able to receive it. So we lost nearly about 60 vehicles due to this non-availability, which hopefully most of this we should be able to recoup as we go forward in this current financial year. But more importantly, from the revenue aspect, if you look at it, thanks to the premiumization that's happening in the market, we've been able to have double-digit growth. In fact, the entire year of FY24, we call it a double-digit year for us in terms of whether revenue, EBITDA, PAT, EPS. I mean, we have double-digit growth in all these aspects. Not only for as a group, as a company, but even the various segments that we are in. As you mentioned, we are in the passenger vehicle, non-luxury segment, passenger vehicle luxury, commercial, EV, as well as in the spares distribution. In all these segments, we've had double-digit growth last year. And hopefully we'll continue to the same trajectory this year too.
Mr. Verghese, thank you so much for joining in with us, and this is Vinny joining in the conversation. What we also want to know that are you seeing any sort of a slowdown in terms of sales that is expected, especially for the high-end luxury vehicles, since there it seems like a bit of a supply mismatch there. And as what your peers have also discussed about this when we've spoken to them, is that something you are seeing, and could that be a spillover effect in Q1 then?
On the contrary, actually, we are, as I mentioned, we are with JLR. So, in fact, we had in our dealership for the luxury brand, we had 158% growth in FY24. Having said that, this year too, JLR has given a guidance that they will be doubling their vehicle sales the next 2 to 3 years. We expect that also to play out, considering that very recently they mentioned that they have done localization of some of the Range Rover models, due to which we expect, more traction to happen for these models. So, as well as I mentioned earlier, we lost nearly about 60 odd vehicles in Q4, which should play out in this year. So, this I think, luxury brand should continue its growth trajectory this year too.
Sir, on a YY basis, we have seen your margins come up to around 4.6% from 4%. Is there further scope for margin expansion here? And given the fact that you have also reduced your debt post-IPO, what is the kind of net profit growth that we can see in FY25?
Absolutely. So our focus and our strategy has been our service pie. So, for the past many years, we've been enhancing our service portfolio considerably, and that has played out. So as you mentioned earlier, in spite of the volumes dropping, as I mentioned earlier, we're having double-digit growth in terms of EBITDA as well as PAT and other financial aspects. So service pie has been growing tremendously. So maybe about 5 years back, it contributed nearly 11% of our turnover. But in FY23, it was about 14%. This year, we increased by another 100 basis points. That's about 15% of our turnover comes from service. But having said that, when we come to the EBITDA level, when you look at the passenger car service business alone, the EBITDA of the entire passenger car industry pie of it, nearly about 65% of the EBITDA comes from the service. And that is why we are focusing on enhancing our service pie of it. So, nearly about 5 years back, the EBITDA margins of service was hovering around 14%. As we speak, we are right now at 19%. The new capex that we put in, most of this are in the service centers. We put in on nearly about 7 service centers in FY24. FY25, we're looking at doubling it to nearly about 14 service centers. So a lot of activity is happening in the service pie of it, where definitely will play out on the EBITDA margins. And as you mentioned, regarding the PAT, definitely one is, of course, we had a fresh offer about 200 crores, which,
Right.
I mean, if you calculate over 9%, which comes to about 18 crores of
Right.
interest cost, that would say. But over and above that, you have find the RBI hopefully will be reducing the
Right.
rates as we go forward. So this will play out in our PAT.
Absolutely. But, I also want to just know in terms of the margin profile one could look at for the after sale services and spare part business, and what is the growth potential for these businesses?
As I was mentioning, the margin profiles, as I mentioned, the EBITDA margins for sales, so for service is about 19%. And that is where our focus has been to improve those to about 20% as we move forward.
Okay, and also could you just help us in terms of any geographies that you are looking at in terms of an expansion there, and where could we see the company entering over there?
We are agnostic to geography. About a year back, we entered into Maharashtra through our Bharat-based dealership. We are looking at various opportunities in the western and northern parts of India, as well as extending towards Andhra Pradesh on the eastern side.
Thank you, sir, for giving us all those details.